Welcome to Unconventional. I'm your host, Bill Tessar. Unique stories from entrepreneurs that have failed, picked themselves up, been knocked down, picked themselves up again, traveled roads that few travel. It's about digging into the successes that people have found in real estate, financing, lending, and the like. Welcome to today's special edition of Unconventional with Bill Tessar. I've always believed that when the rules change, the opportunity changes. And right now, the rules have officially changed. A sweeping new tax law known as the Big Beautiful Bill is now law. And it includes 10 major changes that will impact individuals, families, and real estate investors in 2025 and beyond. This is about more than taxes. It's about strategy. It's about planning ahead. It's about keeping more of what you work so hard to earn. That's why I brought in someone who doesn't just know the tax code. He helps people win because of it. It's my pleasure to welcome Tony Watson, managing partner at Robert Hall and Associates, a federally licensed enroll agent with 2 decades of experience managing client portfolio exceeding 500 million. Tony's a tax strategist, he's a real estate investor, and he's a trusted advisor who understands exactly how these changes can impact your income, your investments, and your bottom line. And he's a close personal friend of mine and someone who I respect and admire in how he's built out his business. So please help me welcome today to Unconventional, Tony Watson. So glad to have you, Tony.
Thanks, Bill. Thank you so much for having me back. Always excited to come back and talk about my industry that isn't always exciting for everyone, but hopefully at the end of today, it'll plant some seeds and help people really grow wealth by retaining wealth, most importantly, right? Utilizing the code, implementing strategies to help keep most of what you've earned and not overspend with the federal agencies and the state agencies. And you're absolutely right. Under this new tax bill, just in the first 30 days of this calendar year, I've seen just an astronomical change in bottom line tax savings for a majority of my clients. And it lands on a couple different parts of the return. And listen, we're early on in 2026. There's still a lot to go through and what will probably change prior to the end of 2026. But I'm already seeing the major changes here, and I'm really excited to share some of the top 10 kind of tax benefits that are built into this big, beautiful bill. My name's Tony Watson. Thank you so much for the intro. I've been working in the tax world for 20 years. I've helped tens of thousands of clients over my career structure their businesses in specific ways to help reduce bottom line liability and help keep more of what's theirs while not overspending just frivolously. People think that the more I spend, the more I'm going to save. Well, but that's also spending money to save money, right? There are other unique things in the tax code where you don't have to spend all of this money while saving massive amounts of tax liability through bonus depreciation, through real estate related loss deductions on short-term rentals. And a lot of this stuff has changed literally over the last 6-7 months. That the Inflation Reduction Act and the TCJA Act under Trump's first administration, the Inflation Reduction Act under Biden's administration, a lot of that has been wiped off the table. Now we have this big, beautiful bill that is in play for 2025 and 2026. And that's what we're filing today is the 2025 tax returns. And I'm, like I said, I'm already seeing some significant tax savings on the back end. So without further ado, I'll go ahead and get started.
Tony, before you jump in, I do want to share, like, one of the things I just love about you so much, and I think it is lost on so many folks that are part of our tax system, is like we go out and we bust our butt to make a dollar. And when you start looking at the federal tax rates and state rates, depending on where you live, in some cases for the higher income earners, it could be as high as 50% plus, definitely over 40. And so no matter what, every single dollar you show someone how they could save legally in our tax code is 40 to 50 cents in their pocket. And I think all of us are on that hamster wheel. We're just grinding to make another buck and to go up the food chain and make more and hopefully save more. But we're missing one of the most important aspects of it, and that's where you come in. And so I can't be more excited to hear your top 10. And I was looking through the deck last night. I think I shared with you earlier, and I found one. I was like, hey, told my wife, hey, your retired father just picked up $6,000 on such and such. And so let's get started, please.
Bill, just that one change, which we'll talk about in a second, it changes things drastically for the accounting world, which we're going to go into stats later in the presentation. But you're absolutely right. These little tweaks can make all the difference for even the retired individuals filing here in the U.S. So I'm excited to share all of that information with you.
I'm going to try not to interrupt you too much, but automatically
Nope.
you said top 10, and I had so many other questions, so I'm going to let you run with this.
Please
Keep going.
do. Please do. No, anything that needs clarification, I get going, and sometimes I realize it makes sense to me. But if you think, oh well, Tony, let's go back for a second. Let's hash that out and make sure that everybody understands. Just let me know.
Awesome.
I by no means am a one-man operation. I work alongside a wonderful senior consulting staff and administration staff. We service around 12,000 tax filings across the U.S. in all 50 states. And so we see a lot here at Robert Hall & Associates, anywhere from the businesses making $10,000 a year all the way up to portfolios worth $150 million. I have a client who owns 37 assisted care facilities in about 16 or 17 different states. His portfolio right now is estimated to be around 150 million. So our exposure on the tax strategy side, on the tax planning side, is unlike any other firm, in my opinion. Maybe there are some firms out there like us, but I have yet to find one. And I've been doing this 20 years. I've met a lot of accountants in our industry. I just can't seem to find a comparable operation to ours. We do
I've
offer
also been paying taxes for over 30 years, and I have not found one like you as well. So
Thank you for that backup, because I feel like I'm going crazy. I can't find anybody else kind of like Robert Hall, but that's good to hear.
He's our unicorn.
I will end on this slide. When we do a little bit of Q&A towards the end, we do offer free consultations just in case anybody would like to have a second review of what's already been filed, see if we can go back and amend some tax returns if there were mistakes made, if there were things missed. So keep that in mind as we go throughout today's presentation. I by no means am here to give legal advice. I do have to mention that our attorneys tell me, hey, Tony, when you're on these webinars speaking to thousands of people, you just got to let them know, hey, you are a tax professional, and anything that you might seem to be speaking on the legal side of the financial fence and the legal fence, just let them know that you're not an attorney and have them revert those questions to their legal advisors. Just want to make sure that everybody understands that. I'm going to stay in my lane of expertise today. So TCJ tax cuts. This is taking a trip back in time to 2017, 2018 during Trump's first administration. There were major changes under that tax bill, and I was kind of hoping that they would be more real estate friendly, and they were, but only on the investment real estate side. When the TCJA Act or TCJ Tax Cuts Act passed, it was really hammering a lot of primary residence owners across the U.S., not so much in the other 47 states outside of New York, California, and Hawaii. We were the 3 states that got hammered probably the heaviest, meaning that when Trump decided to cap state and local taxes at $10,000 back in 2017, 2018, that meant that all of our state income tax that we pay, all of our property taxes on our primary residence and a second personal residence, all of what you paid is capped at 10 grand. That was back in 2017, 2018. I thought to myself, why would the real estate mogul, the person that we've seen on TV, the person that is now our president, probably most famous for his real estate investing, why would he do that? Why would he change the tax code that way? Well, I don't have time to go into detail, but there were already limitations prior to 2017 built into something called alternative minimum tax that already disallowed a majority of property taxes for individuals just making over 275 grand. So a lot of people thought that was a major change, and it ended up being not that much of a change because there were already limitations kind of buried in the 9,000 parts or 9,000 pages of that part of the Internal Revenue Code. The tax code is very, very long, but the majority of what we deal with on a day-to-day basis is the about 8,000, 9,000 pages of Internal Revenue Code. And how would the general public understand 8,000, 9,000 pages of code? That's why you work with a licensed tax advisor. So fast forward to Trump's second term, he has permanently extended a majority of the TCJA Act from his first administration, which extends bonus depreciation. It extends the QBI deduction, which makes 20% of your cash flow or company profit tax-free, depending on what adjusted gross income you file in. So there are a lot of great things that have been extended, but also kind of pumped with steroids under this new tax bill, which we'll get to those in a couple seconds. A lot of the TCJA Act was set to expire last year. That is no longer the case. All of that tax bill has been extended indefinitely, which is crazy to hear that word as part of the tax code. But the Trump administration has added a couple key words into their tax bill where it extends a lot of the benefits for business owners and real estate investors indefinitely. And I've never seen that word used in the Internal Revenue Code before. So we'll see how that sticks. We'll throw things at the wall, see what sticks, right?
So on that particular one, it's not an enhancement. It's just the comfort of knowing it's going to continue.
Correct, because he thought his 2017, 2018 tax bill was great. And so he said, well, some of those things worked. And obviously, when Biden came in, he removed a lot of what Trump had enacted during his first term. So what he did was he just took that tax code rather than rewriting, 6,000, 7,000 pages of the TCJA Act. He just took that, removed a couple things, beefed it up a little bit just to organically flush cash back into the US economy, right? What makes more sense? Cutting taxes for the American taxpayer or printing more cash, right? Think about how much cash we printed over the last 6 years, right? During the pandemic, how much fraud there was. Instead of printing more cash and devaluing the US dollar, I think Trump, and this is a big assumption on my end, guys, I assume that Trump, instead of printing more cash, he wants to lighten up the tax code, and that just organically allows cash to flush back into the U.S. economy. I think it's a great move overall from an economic perspective, but we'll have to wait and see. I'm really pumped about a lot of this stuff, and we'll go into more detail as we get further into this.
Right.
Child tax credits increasing by $200 for each dependent. I was hoping that this was going to be a little bit higher, but I understand that there were a lot of other changes that, once again, will organically flush cash back to the United States taxpayer and the U.S. Economy. But they did increase it from $2,000 to $2,200, so there's a little bit of a bump there. It is based on phase-out thresholds for single and married filing joint couples. If your AGI is above 200 grand and you're single, you start to phase out from being allowed any of your child tax credits. So for the wealthy of the world, the people who are making over 200 grand, 400 grand, they're not able to take credits for having children. And I'm not going to say rightfully so. I think that everybody should get a credit for having young children. But at the end of the day, the federal government and the Trump administration decided not to change this phase in, phase out threshold. So we'll have to wait and see if that sticks as well in future years. It is indexed with inflation, which I don't believe this has ever been the case in past years.
Wow.
Whereas if inflation goes up, goes down, goes sideways, this credit will increase. It won't decrease, in my opinion. I think it will only increase depending on how the U.S. economy is doing.
It's
Bill, you
a
had a
neat
question?
bullet point that you could argue could be applied to a lot of the different parts of the tax code that no one's really thought of, right? So a great
Sure.
tax benefit in 2010 doesn't have the same financial impact as somebody in 2026.
I mean, there's an incredible difference between the code that I once knew when I first started in the tax industry 20 years ago and the tax code that we're looking at today. I've had the fortunate opportunity to work through one, two, three, four, and then the Trump is second term, so 5 presidential changes. And I'll tell you, during the Obama administration, that was probably the first time I really got a hands-on experience with significant tax code change because of the Obamacare bill and the healthcare penalties and a lot of the phase in, phase out thresholds changing. And that was a consistent 8 years of that because Obama was in 2 terms, right? And then enter Trump into the office. And of course, when you have a Republican president, politics aside, guys, when you have a Republican president, the tax bill tends to be very pro-business. They want businesses to flourish because businesses hire employees. And when you hire employees, more gets pumped into Social Security, Medicare, state disability, unemployment insurance. And so all of these government subsidy programs basically are fueled with a lot more influx of cash. Because as business revenue goes up, employment numbers go up, and all of a sudden more people are paying into the government subsidy programs that we fear will eventually, the wells will run dry. I mean, they're estimating that Social Security, the well of Social Security will run dry by 2032. It was originally 2026, and we still have Social Security around, but by 2032, they're estimating that Social Security won't be around for anyone. Enter in the tariffs, and the tariffs are supposed to supplement a lot of that loss overall. I'm getting off topic here, but you get what I'm trying.
That's crazy.
Yeah, it's from an economic standpoint, from just a macro standpoint. You can't just look at one piece of the code and say, oh, that's terrible. You have to see how it's built in with everything else, because the IRS is a very much give and take organization. They give a benefit, they take a benefit, right? In this particular tax code, I have yet to see what's been taken. Let's just put it that way. I'm not saying that there isn't anything that's been taken, but I have yet to see it. And we're already 30 days in. I've prepared close to like 70 or 80 tax returns, including corp and individual returns.
Wow.
And I've yet to see that take so far in 2026. Not saying it's not on the horizon. I'm sure I'll see a lot more as the year goes on, but just keep all of that in mind. Take everything with a grain of salt that you see online. Before I logged in, really quick, before I logged into the webinar today or the podcast, I was looking online and there was a post that said, if you make 200 grand of W-2 income immediately right out the gate, if you're a single individual, they're estimating that between Social Security, Medicare, all of the other taxes that you pay, that you're losing about 70 grand of your income. 200 grand W-2, 70 grand goes to some sort of tax, right? And it says that literally under this new tax bill, through investing in short-term Airbnb and VRBO real estate investments, you can literally pay nothing in federal and state income tax. Now, you still have to pay Social Security and Medicare, all the government subsidies we're forced to pay into. But as far as the federal and the state income tax are concerned, the larger tax rates that we pay, literally, if you invest your money, there are ways for you to pay nothing in federal.
So simply, 70 goes into real estate that you own, that appreciates, you get tax benefits and all the luxuries of that, or you pay the government. You just pick.
Correct. That 70 grand could be a nice down payment, and then we'll get into the benefits of cost seg and all of that other stuff that changed for 2025 and 2026 and moving forward. But yeah, that's and I couldn't have explained it better. I know that that's a very vague example, a very kind of general example, but it's not too far off. Pending a couple things that I need to make sure fit into the puzzle, putting the pieces of the puzzle together. But it's very possible for you to make $1 million in income and pay nothing in tax. That's the wildest thing, but you got to work with a tax advisor who knows how to do it legitimately, right? Because there's not so legitimate way, and then there's obviously the legitimate way. So child tax credits indexed with inflation, looking forward to see how those get bumped up. Number 3, probably one, if not the number one most significant change, probably number 2 or number 3, because we're going to get to a couple other changes in the upcoming slides. This was one of the most impactful changes under the big, beautiful bill. Trump's first administration back in 2017, 2018, they capped that state and local tax deduction at 10 grand. Once again, property taxes and state income tax that you pay in whatever state you file in, you were capped at $10,000 in total write-offs. People thought that was a nightmare. Why would he do that? Well, because of alternative minimum tax in prior years, some individuals prior to 2017 weren't allowed any of their state and local tax deductions. And this is where the media outlets and a lot of the advisors out there don't do a good job in explaining a lot of these changes, especially if they have a political agenda kind of sitting on their shoulder. They're like, hey, I want to make sure that people hate Trump. They want to hate the president that's in the White House. They want to hate the tax code because they don't understand, right? They always hate what they don't understand at the end of the day. Well, alternative minimum tax prior to 2017, you could make over 300 grand and all of a sudden be subject to this AMT and not be allowed any of your state and local tax deductions. At least in 2017, 2018, that threshold of 300 grand where AMT started to kick in, that bumped up to $750,000+ of income. So anybody making under 750 grand or between 300 grand and 750 grand, under Trump's first tax bill, the TCJA Act, they were actually gaining a $10,000 write-off because in prior years, they weren't allowed any of it. So once again, take everything with a grain of salt, talk with a tax advisor who understands, who studies this stuff every single year, because it might not always be what it seems, right? Don't take things at face value. Dive in, talk to professionals, surround yourself with educated people, and get opinions from both sides, right? And see where the education lands.
And this is adjusted gross earnings, right? This is after your deductions?
That is correct. That is correct. So that SALT deduction is based on AGI. And I'll tell you right now that a majority of what we did in Q4 of 2025 through our planning sessions was to figure out as many ways as possible. And there are some clients who, no matter what we do, they're not going to be under 500 grand. I totally understand that. I got some clients who we could crank those deductions all we want and we'll save them a ton of tax at 50%, whatever, 51%. But at the end of the day, it's impossible for some people to drop below 500 grand. But if we are able to drop them below 500 grand, all of a sudden, instead of that $10,000 cap that they're allowed, it bumps up literally by $30,000.
That's crazy.
So I've seen a number of clients gaining a $30,000 itemized deduction simply because of getting themselves below 500 grand. And it's a lot easier for business owners to do that because they can dollar for dollar expense certain write-offs, or real estate investors. It's easy to kind of take more depreciation write-offs, drop them into a lower income bracket. All of a sudden, the ROI, the return on investment per dollar that you are spending, can be upwards of 44 to 48 plus percent or cent to the dollar. You spend 100 grand, you save $48,000 in tax. I mean, who would not do that at the
Yeah,
end of
that's
the day?
right.
That's a
Right.
majority of what you're doing in
It's
year-end planning.
crazy.
So this is something that you need to be aware of. You need to do whatever you possibly can to get yourself below that threshold and gain that potential $30,000 write-off. Now, if your property taxes and your state income tax are only 15, 20 grand a year, you're not gaining 30 grand at that point. You're just gaining the delta, right? Last year, you were capped at 10 grand. In 2025, if you're paying 20 grand in state and local taxes, you're gaining an additional $10,000 write-off. So
Wow.
there are some people who won't gain the full 30 grand. It really all comes down to how much you paid throughout the year in state and local taxes. It is set to revert back to 10 grand after 5 years, but there is a great chance. There's a better than not chance. I don't know if that's the right phrase, but there is a greater than bad chance that this will be extended pending on who replaces Trump after his term in the White House. So we'll have to wait and see where that all lands. I think that it's absolutely insane to keep it at 10 grand. But remember, just take a step back and remember that really the only three states that are impacted drastically by this particular change in the code, the 10 grand cap, are California, New York, and Hawaii. The
Yeah.
rest of the US, the other 47 states, some states have very low property taxes. Some states don't even have state income tax, right? So at the end of the day, all other 47 states, they were not impacted by this. Once again, politics aside, you got to make sure that you utilize a code under a Democratic president, under a Republican president. The importance of planning and strategizing is equal. Doesn't matter who's in the White House. The importance of planning ahead is always going to be top of mind if you want to help yourself retain wealth and not overpay in income tax, right?
Good point.
So
Good point.
Number four, one of the things that I'm seeing big time here in Los Angeles, especially with barista, I don't do a lot of tax returns for baristas, but baristas, I do a lot of tax returns for nightclub hosts and promoters and event planners. A lot of their income tends to come, like bartenders. I mean, I got a bartender who makes over 200 grand a year here in Los Angeles. So when you talk about this overtime, right, we thought that for sure overtime was going to be non-taxable altogether, but it ended up kind of the dust settled around $25,000 of tips for workers earning under 150 grand, and for married filing joint under 300 grand. So now this is not something that they're going to allocate on your W-2s. I think that in 2026, a lot of this will be cleaned up, but the bill passed so late in 2025 that I don't think the payroll companies were able to catch up with a lot of the current legislative changes. I think that in 2026, your W-2 will actually show you what portion of your wages should be non-taxable for tips and overtime. I mean, sorry, tips this is tips and overtime. But at the moment, the W-2s don't say that. So I just had a firefighter client who's got a lot of real estate and he has a ton of overtime. And we actually had to ping his station and they calculated the amount of his overtime that was non-taxable. Well, it wasn't quite 25 grand, so we had to plug in like $22,300 or whatnot. But that on top of the SALT deduction change, I mean, that ended up saving him, I think, over $12,000 just in 2025. It made the world of difference for a public servant employee,
I mean, massive.
Massive.
So to break this down simply, are you saying that for somebody that earns tips or works overtime, the first $25,000 is tax free, and then tax applies to $25,001?
That is correct. And remember that for married filing joint individuals, they get the full $25,000, right? So it's not $25,000 for single individuals. I don't know why that wasn't. Maybe it's the next thing. Here we go. Yeah, I didn't click the next. So overtime deduction is capped at 12.5 for single individuals, 25 grand for married filing joint. So it's not 25 grand if me and my spouse both have overtime. If I'm married, and let's say my wife is a self-employed individual or a stay-at-home, primary parent, I can take 25 grand of my overtime
because you're married.
Joint. Correct.
Wow.
Correct. And I have a much higher income threshold that allows me to qualify, even though I make more than a single individual. So really exciting stuff here. And if you want to dive more into detail about that, obviously reach out to our office. Let's see what you qualify for. But it's kind of the Wild West at the moment because there really is not very much guidance. In fact, the government is on the breach of another shutdown right now. There's just a lot going on in the world. So if you need guidance, professional guidance on this particular part of the code, reach out to us. We'll map out the scenario for you. We'll help guide you through this kind of the rough waters of the big beautiful bill and 2026 tax season. Great benefit here, though. I'm very excited to see how, economically speaking, how this kind of changes things for us U.S. taxpayers. We'll have to wait and see. Federal income tax on Social Security. Bill and I were just talking about this pre-starting the podcast today. Get this, and I'm not going to click to the next bullet point just yet because I want this to sit with you for a second, okay?
Crazy.
Out of all taxpayers in the US that collect Social Security, we call them Social Security benefactors, people who are benefiting from a government subsidy that they paid in to that government subsidy or that government well, so to speak, for however many years. They are now in retirement and they are pulling from that Social Security benefit, which they paid into the system. And now when they collect it, it is taxed on the federal side, but not on the state side, right? So the Social Security that you collect, it's never taxed fully, but you pay tax on up to 85% of what you collect, depending on what your other income is, right? California taxpayers tend to actually pay federal tax on their Social Security income because that Social Security benefit is being added on to their capital gains and their dividends and their interest and maybe even small business income or cash flow from real estate. So Californians and New Yorkers and even Hawaiians, we tend to actually pay tax on our Social Security benefit. The other 47 states, there's a majority of the US that still, to this day, you can live a very comfortable life in those states solely on Social Security income without any investments. There are still places in the US where you can live on just Social Security income. And at that point, if Social Security is your only source of income under the current tax bill, last tax bill, past tax bills, if Social Security is your only income, none of it pays tax. If that's your only source of income, it's really only if that Social Security is added on to other types of income that it could put it into the taxable range. But get this, starting in 2025 and 2026, if you are a Social Security collector or benefactor and you are earning under 75,000 single, 150,000 married filing joint, you get a temporary, right? Because this is in place to 2029, because that's when Trump's administration ends and then we have to figure out who's going to be president next. So it's a temporary deduction that is added on top of your standard deduction or your itemized deduction. So imagine this, if you're at a $33,500 standard deduction, you get an additional $6,000. Now the first $39,500 of your overall income pays nothing in tax, right? Wow. So it's added to your standard deduction. But get this, a lot of people are saying to Tony, Tony, this doesn't seem like that much. And remember, it's $6,000 per taxpayer. It's $6,000 for the primary taxpayer, $6,000 for the spouse if they both are Social Security collectors. So it's $12,000 potentially in overall deductions. But get this, just by adding this small $6,000 deduction per taxpayer onto a return, it will lift 88% of Social Security beneficiaries out of a tax filing requirement. So any individual who was required to file a tax return because of taxable Social Security and other income, this change alone will lift 88% of the United States population Social Security benefactors out of a filing requirement. They won't have to file a tax return because they won't pay tax. Now, they're going to want to ping their accountant, see if that's the case. But at the end of the day, it's going to make a world of difference for seniors in retirement. And I think that the Trump administration did a really great thing here by adding this benefit. Once again, politics aside, I'm not here to be a politician, I'm not here to be a political analyst, right? Solely based on this and changing 88% of Social Security benefactors' filing status is just a massive change. It's something that we've never seen. In my 20-year career, Bob Hall in his 50-plus year career, and he's been around for a very long time, a professional in this industry, we've never seen anything like this. And who knows if the rumors are true? Is Trump really heading towards abolishing the IRS and federal income tax altogether? Is anything possible these days? Sure. I mean, my head's on a swivel every day. Is it probable that the IRS will be gone and federal tax will no longer be around? I don't know if it's probable, right? I'd still have a job because I got to file on the state side. But at the end of the day, that is something that he has said verbally. I've watched his interviews. He said he wants to abolish federal tax because of how much income the federal government is collecting from the tariffs on other countries. So TBD, right? To be determined. We'll have to wait and see how all that maps out. But once again, a very unique change. One thing that used to be tax deductible, this predates my time in the tax industry, is auto loan interest. Now, this is starting in 2025. but it is only for US manufactured vehicles and only on new vehicles, not on old vehicles. Old vehicles can still be a great write-off for depreciation purposes and registration purposes, things like that. But if you want the auto loan interest deduction of up to $10,000, one, you have to purchase a new American manufactured or US manufactured, US assembled vehicle. I'm sorry, US assembled vehicle. And the dealerships are going to be able to tell you whether or not the final destination of assembly or manufacturing is on US soil. They're going to have that
Wow.
in because of this change. And you'd be surprised at how many vehicles, even though they're foreign manufactured, how many vehicles come here to the US and their final assembly location is here in the US. Back when bonus depreciation was bumped up to 100% back in Trump's first administration, a lot of those foreign automotive makers, because this actually was supposed to be applied to the bonus depreciation as well at one point. A lot of the foreign manufacturers, what they do is they put together 95% of the vehicle, ship it here to the US, slap some wheels and tires on it, install the GPS software, and then stamp it US soil as the final destination of assembly. And then all of a sudden, they qualified for some of these benefits, right? I don't think that is going to be the case here. You want to make sure, and you can go online and look up lists. I'm sure that there's very thorough lists online about this stuff, but the main US manufactured vehicles are GM, Ford, Chevy, the big time US manufactured names. And this is really meant to stimulate the automotive industry here in the US and take back a little bit of power from the foreign automotive makers. What does it do economically speaking for the US? I mean, the automotive industry employs hundreds of thousands, if not, I wouldn't be surprised if it's over millions of people who are employed, maybe not directly through GM, but all of the other people who are employed, the dealership cleaners, the maintenance workers that come in and do contract work for the dealerships. There's a lot of jobs that are created. So when you stimulate the economy by allowing people a deduction for their auto loan interest, now all of a sudden purchasing a new vehicle for that family that's got a 1978 Chevy Suburban. I don't even know if Chevy Suburbans can be that old, but if they got a super old vehicle, now all of a sudden it might make sense for them to go out and finance a vehicle because of the allowed tax deduction on the auto loan interest, right? You got to think not just in your bubble, not just in your world, but what does this mean from an economic perspective domestically, right? Not internationally, but domestically here in the US. It could be a pretty nice benefit for a lot of people. Phase out starts at 100 grand if you're single, 200 grand if you're married filing joint. So this is not a deduction for the wealthy people. This is a deduction for individuals, for married filing joint, dual income households with a couple kids, the people who need to go from a sedan to an SUV because they've got children and sports gear and all this stuff that I'm going through with a 4 and 7-year-old. I mean, we need those bigger vehicles, right? As long as it's US manufactured, up to 10 grand in auto loan interest, but your income has to be below one of those two thresholds. Just once again, a very unique addition to this tax bill in 2025. One thing that has impacted my specific column of clientele the most is the reestablishing of the 100% bonus depreciation write-off. This not only changes the automotive deduction for business owners, and that's a whole other conversation. I know that people want to go out and buy these G-Wagons and the Range Rovers and all this stuff. Remember that in order to get bonus depreciation, it doesn't have to be a US manufactured vehicle. It just has to be titled, insured, and paid for under the name of a business, right? It can't be if you're a W-2 wage earner, you can't write off bonus depreciation on a vehicle against the W-2, but you can write it off against a business, right? And business income. And if it happens to kick you into a loss, that loss can flow through and offset your W-2 taxable income. So there's a strategy behind utilizing this benefit to offset W-2 income, but you got to let us map that scenario out for you.
I got a question for you there. Pause there for a second. So it's 100%. Last year, is that also over 6,000 pounds? Are you going to get to that?
That is over 6. Yeah. So I'm getting to the weight class of the vehicle. I wanted to hit the bonus depreciation on real estate first, though.
Yes.
I had mentioned earlier about this post that I saw online about somebody making 200 grand via W-2 and paying 70 grand in overall tax across the board, and then going out and buying an Airbnb or a VRBO and then being allowed basically to wipe out all of your tax liability. This is the specific way to do that. You go out and you buy a short-term rental investment. Now you've got a capital asset that in the long term is going to continue to appreciate in value. You're going to have equity. You can borrow against that equity down the road. You can leverage it to acquire more assets. That is the number one most consistent asset amongst the 1% of the world. It's real estate. They have other things, right? But the one consistent investment that the wealthy have in America is real estate, building and land, right? So the federal government in 2024, so not in 2025, but in 2024, Biden's administration was phasing out the 100% bonus depreciation benefit. It was supposed to drop to 40% in 2025. Enter in the big, beautiful bill. They reestablished the 100% deduction. So now if I am making, let's say that I am solely W-2'd and I'm making $700,000 on a W-2, great W-2, consistent income, paying, just getting hammered in federal and state income tax on 700 grand. I go to my accountant, I'm thinking, I need to use my money to buy real estate. What do? Do I buy long-term rentals? Do I buy short-term rentals? What does that mean for me tax-wise? Well, most people will lean on the long-term rentals first because they want that consistent, either passive or non-passive income that builds over a long term. They want the consistency of rental income per month. The problem with long-term investment income or long-term rental properties, when you make that kind of income, in fact, anything above 150 grand in adjusted gross income, the problem with long-term rentals is that any losses on the Schedule E because of depreciation or mortgage interest or property taxes, they are not allowed as loss deductions unless you or your spouse are a real estate professional. That's on the long-term rental investment side. So you got to make under 150 grand, or one of you has to be a real estate professional to allow that loss deduction on a long-term rental property to help you save tax on a 700 grand W-2. Fast forward to the big, beautiful bill, right? Code changed a little bit. So instead of applying that method to both short-term and long-term investments, now if you go out and making 700 grand, right, not allowed those real estate losses for long-term, if you take that high W-2 income, you go out and leverage your credit, you go out and leverage the cash for a down payment, and you buy a home in Big Bear or Lake Arrowhead or Palm Springs or by the beach or in Tahoe or Mammoth or, Aspen, wherever you're going to buy it, where short-term Airbnb and VRBOs are more common, and you're making 3-4 grand a weekend. In some cases, I've got some killer Airbnb clients that, they generate $200,000+ in gross rents because they rent it out for wedding venues and bachelor parties and, special events. There's a whole world of investing through short-term. But if you're making 700 grand and you fear losing that loss deduction, all you have to do is invest the money in a short-term rental, because no longer are you buying a long-term rental investment, you are buying a business. A short-term rental investment now gets filed on a Schedule C, not a Schedule E. The Schedule E form is the one that has limitations because the Schedule E is for long-term rental properties, right? And there are limitations there because you make too much to take the loss. Now, all of a sudden, the short-term rental is filed on a Schedule C, which is a small business tax form. And through cost segregation, where we can take bonus depreciation on the building value, accelerate it all in 1 year, potentially giving you hundreds of thousands of dollars in depreciation write-offs on top of the mortgage interest, the property taxes, improvements, travel back and forth from the property, furnishing the unit. All of a sudden, I'm making 700 grand. If I can show a $400,000 loss, a legitimate $400,000 loss, while not actually losing 400 grand. I'm just telling the government, hey, I don't want to wait 27 and a half years for this depreciation write-off. I want to accelerate a good chunk of it, take it now to save money. In that case, you're not only dropping yourself below 500 grand now, allowing yourself the full $40,000 state and local tax deduction, because remember that phases out at 500 grand, but you are significantly cutting your effective tax rate almost in half, actually. 700 grand decreased by 400 grand. Now you're paying tax on 300 grand. That 400 grand alone in your income bracket, probably at the end of the day, just estimating an overall tax savings of close to 200+ thousand.
Unbelievable.
Now, if I get to keep 200 grand, right, because of this cost seg, I put all the pieces of the puzzle together. What do you think your accountant or your wealth manager wants you to do with that 200 grand? Not go out and buy a Porsche. I'm a car guy. I love my cars. I love my car that I drive, right? But with this tax savings, you don't want to go out and buy luxury assets. You want to take that 200 grand, and in the following year, when you've saved all that money, you want to buy another short-term rental. And guess what we do? We just copy and paste. And all of a sudden, you've allowed your real estate acquisitions to pay close to nothing in tax. And all of that tax savings that you're reaping the benefit of, you want to use that as a down payment on a new short-term rental.
Beautiful.
We cost seg the hell out of it, and we, obviously onward and upward from a real estate portfolio building perspective. That is the way
strategy.
That is the way the 1% builds wealth. Now, it's much easier for them to do it because they have the money to do it. But remember that if you're making 700 grand, you probably don't feel wealthy, right? Compared to the 1%ers of the world, because you're paying 46% in tax, let's say, across the board, plus property taxes, state income tax, local ordinance taxes, so on and so forth. So How do we get around paying all that tax? Well, you've seen the Instagram posts, you've seen the YouTube videos, you've seen all that stuff. And I love those posts. I love that people are educating themselves. You just got to take all of that education with a grain of salt, because it gives you the idea, it plants the seed in your mind, but it does not come full circle as far as what needs to happen, the checks and balances on how to make that happen for you personally, and personally and professionally. Talk with your tax advisor about this. This by far
One quick
is
question. Does that go
invent-
back? Does that go back to 24? Do you recapture anything at 24 or just start in 25?
because remember that Trump in in his I don't know how to describe it. Trump does not want that to go back to 2024 because he doesn't want it to be known or thought of in future years as a Biden change,
Got it.
right? Because he wants people to know that in 2025, when he was elected president, these were his changes.
Yep,
right?
I understand. Yep. That's
So,
crazy.
Yeah, wild, wild. So let's talk in more detail about that. When you reach out for the free consultation, we could dive in and map that out for you. On the car vehicle purchase side, some mutual friends that Bill and I know, they've gone out and bought G-Wagons. They've gone out and bought Range Rovers. They've gone out and bought Tesla Model X's, Chevy Tahoes, Ford Raptors. I mean, these Ford Raptors these days, 207. I saw one for $270,000, a
Wow.
Ford Hennessy. That is a I know what I would buy with 270 grand. It wouldn't be a Ford Raptor, even though they're beautiful trucks. I just don't know if I'd spend that much on a truck. I wouldn't spend that much on a car personally, financially at this moment in my life, but hopefully down the road I will. But 270 grand. I mean, think about the tax benefit of it. If you're gonna spend money on a truck like that, if you make enough to warrant a purchase of a vehicle at 270 grand, it more than weighs over 6,000 pounds. These Ford Raptors are massive, big V8 engines, 700, 800 horsepower. You got to title it, insure it, and pay for it under a business, right? And at that point, it meets all the qualifications. Weighs over 6,000 pounds. In this case, it's a U.S. manufactured vehicle, so even if the code does change, that would still be allowed. That is a $270,000 dollar for dollar deduction against your.
Unbelievable.
You make 270 grand in gross income, you buy the Ford Raptor, you literally wipe out all of your income down to $0. On the federal side, the craziest thing about this part of the tax code is California has not conformed to it. So guess what? California is still going to tax you on the 270 grand of income. Federal government's going to not tax you anything on the 270 grand because you've dollar for dollar offset it with the bonus depreciation write-off. And that it does not have to be U.S. manufactured at the moment. Could that change down the road? Sure. TBD, to be determined on that. But once again, this helps businesses write off equipment and machinery costs, including vehicles, right? Most beneficial for cost segregation on real estate and vehicle purchases over 6,000 pounds gross weight. So when you type
Quick
in
question for you on that. Is it the year you bought it? So the cars you buy in 25, you write off in 25, the cars you buy in 26, you write in okay.
Correct. It has to be keys in hand, right? It has to be date placed in service, and that is the year that you write it off. Now, remember that when you Google search these vehicles, it's going to give you the curb weight right up front. You're looking for gross weight. Okay, gross weight tends to be about 1,000 to 1,500 pounds heavier. So a lot of people say, "Oh, Tony, the car I was looking at, it doesn't qualify." I say type in gross weight, and all of a sudden it bumps up to 6,300 pounds. Boom, we're off to the races. A lot of these vehicles, the Porsche Taycan, which is the electric sedan, that weighs over 6,000 pounds because it has lithium ion batteries and they're super heavy. So just be aware of those changes. I know that we're getting to the top of the hour here, so I'll kind of scoot through this. Charitable deductions for non-itemizers. The government's giving you a freebie $1,000 charitable write-off if you're single, $2,000 if you're married, filing joint. You don't even have to itemize your deductions. You just get a freebie charitable deduction write-off, something that has never happened before. In past, they used to give like $300 per taxpayer in miscellaneous cash. They've bumped that up significantly. Now, here in Los Angeles, we're going to have a lot more charity for our clients this year because of the wildfires. So once again, I think that we're already going to be itemizing charity, but this is an added $1,000 to $2,000 depending on filing status. No need to itemize for this benefit.
Just so I understand that, if I had $20,000 in itemized deductions, you would deduct 20 plus 2?
Well, no, remember that it depends on if you're single or married filing joint, right? So if you're married filing joint, $20,000 is not greater than the standard deduction. So you would actually be taking the $31,000, $32,000 standard deduction plus the extra, or I'm sorry.
The extra.
Yeah, no, I'm sorry. The new standard deduction already includes this, I believe, which is 31 to 33 grand, depending on your age. But once again, if you're already itemizing $40,000 in itemized deductions, then yes, the $40,000 to $2,000 gets added on to that $40,000 deduction. Yep. So keep that in mind. Trump accounts. So had a lot of questions about this stuff. It's only for it. The Trump administration is seeding a deferred retirement account for every single child who was born between the years 2025 and 2028. If your child was born in 2024, unfortunately, that's a Biden birth. I call them the BBs, the Biden births. They don't get the $1,000 Trump seeded account. So I have yet to see how you sign up for this. I'm not sure how this is all going to map out. I have not signed up any of this for my clients. There's nowhere on the tax return to check a box to apply for it. I think it somehow is going to map out in 2026 where literally your children, they're very much like Social Security at the end of your life in retirement. This will very much grow tax deferred, right? Not tax free like a traditional IRA or a 401k, not a Roth, but a traditional account. It will grow tax deferred, and the government's going to automatically seed $1,000 per new child that was born in 2025 through 2028. Can't wait to see how rampant the fraud is on this. Well, TBD, right? TBD on all of this, but once again, a really great benefit for a lot of people who had new births in 2025 and 2028. Once again, tax deferred, not tax free, right? So it grows like a traditional IRA or a 401k, kicking that tax can down the road until you kick the can. EV vehicle credits and clean energy credits phasing out. 2025 is the last year that you were able to take it. So make sure that when you file for 2025, you're still applying for those energy efficiency credits. As of September of 2025, EV vehicle credits are gone. Energy efficiency improvements to your house, new HVAC systems, tankless water heaters, electrical panel upgrades, windows, doors. I think I said drywall insulation, but if I didn't, drywall and insulation, all of that still claims as a credit for 2025, but as of 2026, no longer available. Solar credits phased out for residential properties in 2025, but solar on commercial property is still good through summertime of 2026. So if you're putting commercial or solar on a commercial property, you're still good through mid 2026. It looks like having commenced construction by July 4th of 2026. So just keep all of that in mind.
You think that has an impact on the solar companies or EV?
Yeah. Yes, I do. Yes,
Yeah.
I do. I think that's going to have an impact, but we all know that Trump is an oil man, right? He wants oil, he wants energy. Clean energy is going to be there, and people are doing it. In my opinion, personally, energy efficient upgrades are a luxury upgrade. Not everybody has the money to do solar, right? And it does great things for our environment, but at the end of the day, not everyone needs solar, right? Not everyone needs an energy efficiency vehicle, right? There's local transportation. If you really want to do something good for the environment, try to drive less, right? Try to take buses, try to take public transport. Not here in Los Angeles. Los Angeles is dangerous. But in New York, not a lot of people drive. In the rest of the US, they have to drive, but they don't drive a whole lot. And when they're they're getting greater gas mileage. Anyway, there's a personal and a professional opinion I have about that. But yes, I do believe it's going to impact the solar industry as well as the EV vehicle markets. TBD, to be determined. This is so brand new. So,
but it is a good point that it's really you don't have as many lower middle class folks spending their excess money that they have on solar. They're going to put it into their family in some sort of, so that probably doesn't impact them. And the super wealthy, it was a nice thing to have the benefit, but they probably didn't do it because of the benefit. So maybe a piece in the middle there that it'll impact.
And get this, the IRS during the years when the solar credit started and 2025, they found that over 30% of the credits that were issued during the pandemic years alone, over 30% of the credits issued were fraudulent. Those people didn't even have solar panels or batteries on their house. So, I think that
they just claim they did.
They just claim they did because there was very little oversight of that. You didn't have to attach a contract. You didn't have to prove that you had solar. But now with the ability to use Google Earth to look at people's roofs, the federal government is using Google Earth as a form of auditing people who say they have solar. And then all of a sudden they're pinging that they have this special division. I don't know if they're still around because the IRS lost 50,000 plus agents, but at least up until the end of Biden's administration, end of 2024, there were special divisions of the IRS auditing people. And they found that over 30% of solar credits that were issued, people didn't even have the solar panels on their roofs. 30%.
Wow.
That is, once again, that equates to, if not hundreds of millions of dollars in fraud, in the $1 billion range of fraud.
And that would be tax fraud.
Tax fraud, for sure it
Wow.
would be. Absolutely tax fraud. So just be aware of all that. One great thing that I think will change is giving back teachers and educators a credit on their return. I kind of fast forward through this, but even if they don't itemize, the teachers of the world will still continue to get a little bit of a credit for out-of-pocket costs. Now, I don't think that it's nearly high enough. I'm hoping that that $300 cap is lifted up to at least 2-3 grand. I have some teachers who spend $15,000 on classroom supplies, on rewards, on field trip expenses out of their own pocket because the district doesn't pay for it. And they aren't allowed that as a federal tax deduction anymore since 2017. So I do believe that the Trump administration is going to bring some of this back specifically
Yeah,
for our
that's a
public.
miss. That's a miss. Like, we have to do that for those folks.
Yeah.
In the entire slide, that would be the only one that would put a real frown on my face.
Yeah, same here. I come from a household of two educators, and I think back to when I was a child and the amount of work and time and effort and money that they came out of pocket for in their education careers. And my uncle's an educator. It just makes me very sad to see that teachers specifically are not able to deduct. Now, I think that the theory behind this, once again, I'm not playing favorites here, but I think the theory behind this was to push the reimbursements back onto the districts and have the districts reimburse the teachers, because why should it be the government, the federal government's oh gosh, what's the term I'm looking? Why should it be the federal government's obligation to cover these types of expenses? The Fed is at the federal level, right? Over 50 states. Technically, it should be the states that are determining, I mean, let's just put it this way. I know we're getting to the end and we'll wrap up.
That's okay. We got some extra time. Stay with me.
Just the marijuana industry alone in California was supposed to generate over $75 billion of additional revenue for California education, right? Over $75 billion. That was a game changer thing. Well, what happened at that point? California and the federal government introduced 280E, which limited the deductibility for marijuana companies to write off their payroll, their marketing and advertising. So all of a sudden you have a marijuana company making $10 million a year, right? And let's say $7 million of that $10 million in revenue is payroll, advertising, and other costs. They can't write that off, right? So their profit is $3 million, but they're paying tax on $10 million.
Oh my God.
Tax than what their profit is on that income. It didn't make sense. So all of a sudden, what happened to these marijuana companies that were supposed to pay for $75+ billion of California education costs? They went back underground. They went back to their trap houses and all of the, I mean, and I've seen it because that was a big thing in the tax world. How do we bring them on board legitimate? And only the big marijuana companies actually are still standing at the end of all of this. But, it's just cutting their nose off to spite their face. We see it a lot with franchise tax board.
It's strange. The math just doesn't seem to work. Even if you're big, if you can't write off 60 to 70% of bona fide expense, I don't know how. I would love to see the P&L on that company, how they're still making money.
It's a rabbit hole, Bill. And another equal position that was taken by the feds over the last decade was limiting the amount of R&D costs for tech companies. So as you can imagine, Google did a huge layoff in the year where research and development costs were then limited. They have to now be amortized over, I think, 10 or 15 years. So now Apple and Google and Amazon and Nvidia, they make billions of dollars, and they probably have hundreds of millions, if not billions of dollars in payroll costs. If they are paying IT developers, IT workers to develop a product that is a service that they are offering, a software program that they're selling to their clients, they can't write off 100% of the payroll costs for the IT and software developers. That's why, in my opinion, from a macro view, I think that's why tech has taken such a big hit over the last, 5-6 years. We saw it fluctuate during the pandemic, but once again, the feds and the states are cutting their nose off to spite their face. They're not allowing the U.S. economy to flourish as it's supposed to flourish, and I don't know the rhyme and reason behind it, but something's got to change.
Yeah, I agree with that.
And hopefully it does, because and then all of a sudden teachers won't have to pay for field trip costs. The parents won't have to pay. I mean, every time I get pinged from my kid's school, it's, hey, we need to raise $5,000 for this field trip. And then all of a sudden, thank God I make good money and I can pay it. But that's in my school district. What about the other school district? These kids they don't have the same accessibility to certain things, all because the state of California and the federal government can't get on the same page to start funding more for our teachers and our public servants. We'll rabbit hole on that some other day.
I have a question for you. When you first started, you said that you were you were opening up the opportunity for anybody that is watching us now to reach out to you and to have them take a look at past tax returns and potentially amend for opportunities using the code. How far back can you go legally?
So to get a refund, you can go back 3 years. Okay. Now, if something was a mistake in, let's say 2020, at the beginning of the pandemic, whoever was doing your taxes made a big mistake, right? And that mistake disallowed carry forward losses. We can go back further than 3 years, carry forward the losses into the 3-year prior periods, and then get refunds from 23, 24, and 25, right? Or 22, 23, 24. But as soon as this tax season ends, 22 drops off. Now it's just 23, 24, 25 that you can amend to get back refunds. So 3 years. How unfair is this? You can go back 3 years for refunds, but the federal government can go back up to 10 years to audit, right? It's a look back period.
I thought that was also 3 years, Tony.
No, the IRS can go back 10 years, but only under, and I'll use this as an example, only in like Enron cases, right? Mm-hmm. Where they find that it has been such a significant fraudulent position that was taken on your return that they can go back and open up 10 years. In my 20-year career, in Bob's 50-plus year career, we have yet to see an audit go back 10 years. Max has been 3. Yeah. And we've seen that before, but the audit rate right now, full transparency, is non-existent. The IRS has lost 50,000 agents. I think it was close to 80% of open audits in the U.S. were closed out, no change, because of lack of manpower, lack of man and woman power at the IRS during 2025 and 2024. So you're going to see. You're going to see a big shift in audit ratios and audit rates. We don't have case study around this because it's so brand new, but in the next year to 2 years, our firm will start to pull case study from our tax attorneys and the online research that we do. And at that time, we'll bring back all those stats to people on the podcast. So we'll come back with that information.
Tony, one other question I had before we wrap. These are your top 10, and you said you're just digging in. Are you running this code through AI, or like, how are you extrapolating good stuff out of it for you to focus on? Like, there's 8,000 to 9,000 pages. What do you just sub it out with your gigantic company and you take this section, you take this? Like, how does that happen?
Great question. So, I'm not going to say that I don't use AI. I do use AI from time to time just to make sure that I'm staying sane, and that, when it's 1 o'clock, 2 o'clock in the morning and I'm cranking out numbers and I've been doing a 16, 17-hour stretch of tax returns, I will ping ChatGPT from time to time just to get a kind of a balance of my opinion on something. But ChatGPT doesn't interpret the code. It regurgitates the code, right? So if you want to instead of going to the IRS website and going and downloading their PDFs of 1,000 pages and then Word Finder, right? You can go to ChatGPT. It'll pull those documents for you. It'll analyze it and regurgitate the tax code. So yeah, I've gone to ChatGPT a couple times for things, but this is continued education courses that we attend on a year-to-year basis. We do over, now it's dropped back a little bit. We do 750 hours of education as senior partners here at the firm every single year. We go to Vegas, for our conferences. They're 3-4 day conferences where we sit in the room for, hours on end. We learn about tax code updates. So we, as senior partners, do about 750 hours. Our TAs and our junior accountants do about 1,000 hours of education. So they're required to do a little more. With this new tax bill, it is a lot of it's very much a think tank here at RHA. So my 3 partners, Daniel Passon, Philip Duncan, and Mike Watson, my brother, acting CEO of the firm, we get together, we see what we're dealing with, and then we teach our staff and our junior accountants about what we see fit. And sometimes our junior accountants come to us. They're trying to climb that corporate ladder. They're trying to get to that.
I like it.
Yeah, so they're bringing the information to us, and every once in a while we'll get a piece of information that I wasn't able to find in one of the tax books I got from our conferences. It's once again, there is something called the tax code and reading the tax code, and then there is something called interpreting the tax code. That's what your tax advisor should be doing. They shouldn't just be regurgitating the code and applying the book, right? Because the book doesn't apply to everyone equally. right?
Right. Right.
Is all about interpreting and based on filing status, based on age, based on active participation rules, based on basis information, based on carried debt in syndications. I mean, there are so many things that could be interpreted out of a code that tells you that you can't do something that I can pull out and extrapolate and apply it to your return, but not to other people's returns,
Wow.
right? And
Yeah.
that is the interpretation of the code.
That's yeah, that's the beauty of it.
Yeah,
I
very much.
know we're tight on time, but can I talk you into just covering 1031 real quick?
Yeah, sure. Really quick. So nothing changed with 1031 exchanges, which is great. It still is the ability to exchange real property for real property. I got an email the other day asking if they could exchange $300,000 in silver and gold for a property. I said, no, unfortunately, that part of the code is gone. The Trump administration only wants real property for real property exchanges. You could do down leg exchanges, accessing boot and cash to pay off personal debt. At that point, we need to calculate what the taxable liability is on the boot. It's very, very slippery slope there. You could do a like-kind exchange where it's $1 million for $1 million, carrying the same amount of debt. The most beneficial one is the up leg exchange, right? Taking a long-term property, bringing cash to the table and going from $1 million asset that maybe you purchased 40 years ago for 200 grand and bringing another 500 grand of cash, carrying some debt and going from $1 million to $2.5 million. And then with the additional basis adjustment, doing cost segregation, accelerating depreciation, further investing in maybe a higher value property, better exposure in an area where you can increase rents, higher quality of tenant, more units. But yeah, once again, this is the ability to sell a capital asset that you've owned for 40 years and you don't want to pay the capital gain tax, you don't want to pay the depreciation recapture tax, and you are wanting to kick the tax can down the road. And the goal is to kick it so far down the road until you kick the can, right? That's the goal with the 1031 exchange. Because when you kick the can, all of the capital gain that you avoided paying tax on, all of the depreciation that you did not have to recapture now that you're dead, your children get to reset everything. And now 15, 20, 30 years down the road, let's say that $300,000 property is $4.5 million. And you think that might be an exaggeration, but here in California, I see it all the time. You got a $4.5 million property now that your beneficiaries inherit tax-free. Now that's on the income tax side. I'm not going to go into property taxes because we're out of time, but on the income tax side, they get a full stepped up basis, paying nothing in capital gain tax. They could literally sell it for $4.5 million tax-free, which is insane, right? It's insane. I apologize for that. So keep all of that in mind. Okay. Keep all of that in mind, and we could dial that in a deeper conversation. QBI is still a major benefit. Once again, if you're under a certain income threshold for the self-employed individuals and the rental property owners who have cash flow and profit through their businesses, the first 20% of your cash flow can be tax-free on the federal side if you can keep yourself below $364,000 in taxable income if you're married filing joint, $182,100 if you're single. So make sure that you're doing planning ahead of the end of the year to keep yourself below these brackets and now qualify not only to pay tax at a lower income bracket, but also make 20% of your cash flow tax-free. That's it. That's all I got.
Wow. Tony, I'm never lost for words at your enthusiasm of what tax freaks people out, and you hit it with so much enthusiasm and intelligence and thoughtful planning, and it's just I feel very fortunate to have you as a business partner and an associate, and I think if anyone spends just a few moments with you, they would feel exactly the same way. Every single person I've ever introduced to you comes back to me with that same sort of vigor that I had introducing you to them. And so you're a special guy.
I mean, what's not exciting about keeping more of your hard-earned money? People think they come to me to save them tax. They come to me to retain wealth. And I think that wealth retention is a lot sexier than saving tax, right? So that's how I pitch it to people. I say, you might not like coming to me every year, like going to a dentist, which kind of hurts my feelings. But at the end of the day, I understand taxes are an emotional thing for people. They fear the unknown, right? And they don't like paying the government, or they don't like what they're paying or what the government's doing or who's president, blah, blah, blah. But at the end of the day, they come to me. I don't work for the government. I work for my client. They come to me to help retain wealth. And that's exactly the goal. Day in and day out, year in and year out, through proper planning, through tax strategizing, implementation of the strategies, the goal is forever and always to retain and keep most of what you've earned for yourself and not overpay a penny, not paying a penny more than your obligation in tax. Because we all have an obligation pay tax, right? But not a penny more than the obligated amount. So
I love that. If anyone wants to get a hold of you, how do they do that?
So right here on the screen, I have my email at the bottom. You could even scan the QR code that auto populates this little screen where you plug in your phone number. There's this whole thing in the tax world where you have to engage in our services. So when you reach out, you're not going to get me first. You're going to talk to our new client onboarding team. They're going to get all your information. They're going to send you some contracts because then that allows you to engage in our services. I just can't give advice for free to people without you engaging in my advice. There's a big legal issue in the accounting world with me just telling you to go do something. If you go and do it and I don't have all the pieces of the puzzle, that puts my license in jeopardy. So let's get you engaged as a client of our firm, set you up with a free consultation. And if it makes sense for you to onboard with us, if it's a good fit, then it's off and running.
Never had one referral, and I've had a ton go your way. Not one referral that hasn't called me back, emailed me back, texted me saying thank you. Just simply thank you. So you're top of the food chain when we talk about tax strategy, wealth planning, and grateful to have you on our team.
Thank you, Bill. Thanks, and I'm very, very grateful to have CV3 on my side and the professional relationship that we built. Really a pleasure to be here.
Appreciate you, Tom.